Well, banks have been a focus on Capitol Hill this week thanks to a series of hearings focused on the failures of Silicon Valley Bank and Signature Bank. Regulators are on the hot seat today, but lawmakers on both sides of the aisle taking aim at the CEOs on Capitol Hill earlier this week.
Your lack of judgment, Mr. Becker, shows that you should not have been running the bank.
There are CEOs and banks all across this country that are having to pay up for your mistake.
And the taxpayers of America had to pick up the tab for your stupidity, didn't they?
It sounds a lot like the dog ate my homework.
Your opinion on what is a responsibly managed bank is now laughable.
This was bone deep, down to the marrow, stupid.
Joining us now is former FDIC Chair Sheila Bair. Sheila, we should note that was all directed at the SVB CEO, Greg Becker. A lot of finger pointing here, but he certainly didn't point the finger back at himself. There's questions about whether, in fact, the bank had too many uninsured accounts, whether social media had some kind of play, whether it was about digital banking. As you take a step back and look at what has played out so far, where do you think the regulation needs to focus on?
Well, interest rate risk management at the core, that's a pretty basic function for bank management, is to manage interest rate risk, which they just didn't do. And that became particularly devastating when they also had cultivated a very unstable deposit insurance base with such excessive reliance on uninsured deposits. They probably assumed, since these big depositors had other relationships with them, is all part of the same Silicon Valley venture capital club, they would remain loyal, which obviously they didn't do. So, but at the heart, it was interest rate risk management. They had a lot of unrealized losses on securities they were counting as liquid that were not liquid because if they had to sell them to meet the deposit withdrawal demands, which they had to do, they were going to have substantial losses, which was going to wipe out their capital. So it's not. That's what happened. I don't say I have sympathy. I do think that the larger environment of, the pandemic spending, all this deposit money coming in, massive amounts of treasury debt issuance, a lot of banks had increased amounts of uninsured deposits and bought a lot of government securities because somebody had to buy it. And there's a lot of it out there. But that's a broader challenge for the system, which they can manage. But this bank in particular really loaded up on long-dated stuff to get yield and really had an unstable deposit base, and it worked until it did.
Sheila, what about the role of social media here and what that played in the role of the deposit withdrawals? How should banks be assessing the risk that social media poses now?
Well, I don't know if there's much you can do about it other than, cultivate a stable deposit base and have a clean bank. I mean, social media did create the problems. I would say with Silicon Valley now, though, those deposits were going to run as a group. It was all part of the same kind of closely affiliated community. They didn't need Twitter to communicate with each other that they were running that bank. So I think with regard to SVB, that is an overstated risk, but it certainly just underscores the importance of having stable liquidity. Long-term debt's another way you can supplement your deposit funding. That's really stable. People buy long-term debt; they're stuck there for a while. And then again, having a good, strong insured deposit base, and if you have uninsured deposits, people that have a true affiliation and loyalty to the bank. But most important, don't take stupid risk. Have a good, strong balance sheet, and you won't have a deposit run, regardless of what somebody might be saying on Twitter. I do think this short selling thing, I don't support a ban on short selling, but I do think there have been some I suspect there's been a lot of shorts out there spreading misinformation on social media that creates downward pressure on the stock, which also scares people. And I think the SEC should be all over that. I agree with the banking organizations that have called for the SEC to vigorously investigate some recent incidents and hope they will do so.
Let me follow up on Shauna's point, though, because it's not just about SVB where we've heard this argument. That is to say that, look, anybody can raise the alarm on Twitter, any kind of social media platform, and then the ease and speed with which you can withdraw your deposits through digital banking only accelerates the problem, regardless of what that liquidity picture looks like. So, number one, is that a fair argument? And is there anything that can be done on that front?
Well, look, it's not completely new. I mean, during the great financial crisis, when I chaired the FDIC, we were constantly fighting rumors on the internet. Social media was not so much a force, but stuff went viral on the internet very, very quickly about the FDIC. The FDIC was running out of money. Boy, did I have to keep batting that down. So this is not a new problem. It's just different venues can spread this misinformation very quickly. I'm not sure there is much you can do about it, except, when people are manipulating markets through misinformation. The SEC has some authority there to crack down. They should crack down. But most importantly, it just underscores the importance of having a well-managed, well-run, strong balance sheet for your bank. The truth will eventually prevail, as it is, I think, now. There was all this scare about regional banks, writ large. And now I think through some good communication from the government, analysts, people like me know the vast majority of these banks are just fine. The truth is prevailing. Things are calming down. But, the ones that are vulnerable, and there's still a few out there that are vulnerable, they're going to have to keep batting this stuff down. And again, it just emphasizes that even more important now to have stable deposits and a strong capital base and good assets on your balance sheet.
Sheila, when it comes to the stress that we've seen in regional banks, the Fed's role in this, is the Fed making it worse by continuing to raise rates? And what happens if we see another rate hike in June?
Yeah. Well, actually on Yahoo, I called for a pause on December. And I'm an inflation hawk. I really don't like inflation. I really don't like low interest rates. I've been worried about it for years, creating the kind of instability, leverage, inflated asset values that we're having to unwind now. So, yeah, I think it looks like they're going to probably be hitting pause next time. Pause is not a stopping it. Pause is not reducing rates. Pause is just a pause. Assess what the impact of these really rapid, dramatic rate increases have been over the past year. So I hope those are the signals, and I hope that's what they do. I think it's better to tolerate a little more inflation a little longer than precipitate a financial crisis, at which point we're going to have a very severe recession, and they're going to have to take rates back to zero again. And you know what? We're going to be right in the soup. So that is the worst case scenario they should avoid at all costs. Slow down, stop at this point, pause, not stop, pause, assess, and let the markets and the economy adjust to these dramatic rate increases that they've undertaken.
And Sheila, the other big issue that the market's watching closely is the negotiations down in D.C. over the debt ceiling. What risk does this potentially pose to the economy, to the markets? And are you confident that we'll get a deal before that X date?
Yeah. Well, yeah, I am confident. I've seen these kinds of games, and I've said in other contexts, it's a global embarrassment. Why we put ourselves through this, I do not know. At the 11th hour, they will have an agreement. I think people broadly understand on both sides of the aisle the U.S. government cannot default on its financial obligations, and nor can you pick and choose what you're going to pay these people, but not these people. That's just not what a developed world economy, a sophisticated economy, a sophisticated democratic institutionally managed government should be doing. So I think they will get an 11th hour agreement, but the drama around this is scaring people. I get emails and calls, are my T-bills, I'm going to redeem my T-bills, what am I going to do? It's scaring people. Are my mortgage rate's going to go up? It's scaring people. It's unnecessary. And, both sides are right. We shouldn't be defaulting our debt or even talking about it. On the other hand, we are on a fiscally unsustainable path. We have to get spending under control. We should be looking at tax revenues, too. So both sides are right, and it's frustrating. But, I have very high level of confidence. They'll get an 11th hour deal. I mean, there have been some positive signals already from both the president and the speaker. So fingers crossed it gets done soon.
Coming down to the wire, right? Sheila Bair, former chair of the FDIC. Thanks so much.